Joseph Carlson is a popular content creator in the finance space, where he talks about all things related to the stock market as well as his own portfolio and anything he has been buying or selling. And in today's episode, we want to cover a stock that he has just added to his portfolio, and that is in fact Equifax. And for those that don't know, they are effectively a consumer credit reporting agency. They collect and maintain data on over 800 million individuals, over 88 businesses worldwide, and they provide credit scores, credit reports, identity verification services to lenders, employers and businesses, and they also offer fraud detection, analytics, decision-making tools, and essentially they help organizations assess credit risk as well as managing financial decisions. Now, it's one that also trades near the 52-week low, in fact down 8% over the last year, and year to date down double digits, -12. However, over the last 10 years, it is up around 128%. We'll also compare this later on against the S&P 500, and only Wall Street at the moment do consider this company a buy. So we want to understand, is this company a buy, hold or sell? What are our views on the undervaluation? And we'll also just point out on a forward P basis, it does trade above 29 with a dividend that sits at 0.71%. It's also a global company, as we can see, lots of services provided right across many different countries and continents. And purely from a valuation perspective, we see it trading at 30, which is pretty much in line with the 5-year average at 29.6, and given the dividend yield also at 0.69, not far off the 5-year at 0.72, we would say in isolation, just looking at these two models, the company does look reasonably valued. And if we were to take a look at this model as well, although bear in mind we're not looking at any of these in pure isolation, we are going to run it through our own DCF process shortly, but effectively the blue tunnel here is the expected price. Right now we see this company trading right in the middle, so again, three valuation models that we have just highlighted, all giving us the same conclusion that Equifax does look to be reasonably valued. And on a valuation perspective, they do get an F. Main reason for this, compared to the sector which sits at 16.8, you are paying a 73% premium, but as we highlighted, it is pretty much trading around the same levels as what it has done on a historical basis. But in relation to this grading, bear in mind some companies do deserve to trade at a premium. Our question is to understand, is it worth the 73% that is being charged today? And we'll also flag that institutional ownership is pretty high at 96%. We see around 2.9 billion worth of selling over the last year, but a lot more buying in comparison at 4.2 billion, and the same to be said in quarter one. Institutions have been buying a lot more than they have been selling, 177 million versus 99,000 worth of sales. And if we do keep going back, you'd have to go quite some way, quarter three of 2023, to see the reverse of that trend. So for quite some time now, institutions have been very bullish. And if we were to take a look at it from the insider perspective, 1.6% ownership, 99,000 worth of buying, not that much, not that relevant, but we do notice a significant amount of selling at $36 million, although you would have to go to quarter four to see the large chunk of that. And we would always say insider selling, not typically a bearish signal. Insiders sell for many reasons, both personal as well as financial. And if you just wanted to see here, the most recent would have been on the 26th of November, EVP selling 551 shares, netting them $143,000. Again, like we said, insider selling, not a bearish signal in our opinion, but information is there if you do want to include it in your own investment thesis. And we can also see in terms of super investors, while there are a few that hold the company, we noticed just one that did sell some in the latest quarter, but there were a few that did buy. Not something we're going to do a deeper dive on in today's episode, but just something we thought might add some value. Now, in terms of earnings over the next 4 quarters, 3 of them are expected to be growth, and what we do quite like is they have a 100% historical track record, 4 out of 4 beats in 2024, and if we look towards December 2026, earnings per share at $9.31 means they're trading on 26 numbers at a forward P of 23.7. We'll also flag their expectations for 2025 in terms of growth versus 2024. They're expecting top line somewhere between 4 to 6%, and in terms of earnings per share, somewhere around 0 to 5%, with some nice growth to the free cash flows at least in 2025 by around 11%. And nice to note, something we will just touch upon shortly, but they're anticipating to restart the growth in their dividends, something we haven't seen in a number of years, as well as starting a buyback program, which will be a lot of benefit to shareholders, essentially returning excess cash. Now, profitability grade does come in at an A-, gross profit coming in at 57%, well above the sector at 31%, pretty much in line with their 5-year average. Bottom line, pretty strong, 11%, again above the sector at 6%, marginally lower than their 5-year at 12%, and cash this company generates from operations over 1 billion, 1.32, well above the sector at 368 million, and marginally above their own 5-year at 1 billion. So good to see, whilst margins are pretty much in line with historical averages, they are generating more cash than they have so over the last few. And then when we look at the same for the growth grade, where they get a B+, year-on-year revenue 8%, forward-looking pretty much the same, above although slightly the sector at 4% and 5% respectively, and a little bit lower than what they have been growing at over the last 5 at 10% and 8%. In terms of EPS, anticipated to grow over the next 3 to 5 years at 18.2, above the sector at 11.5, but also above their own 5-year at 13.1. And we'll also touch upon some of their underlying metrics. Nice to see, firstly, dividend score of 82 is very safe. Now, we covered these two valuation models, and we'll also touch upon the dividend growth, although we should say the lack of. And as we do keep on going, just something to bear in mind, they did have their dividend safety score taken a look at, and it was reaffirmed a few months ago. It is very safe, and that ultimately a dividend cut for the company is highly unlikely. Now, in terms of key metrics, bear in mind this is how they performed in the 07-09 Great Recession. They maintained the dividend, didn't increase it, but also didn't cut it. Average growth 12.8%, S&P during the time was -12%, and they marginally outperformed the S&P, -49% return, with the S&P itself -55%. Now, we've touched upon dividend growth. In fact, over both the last 12 months as well as over the last 5 years, there's been no increase. They've just purely maintained it. Over the last 10, on average, 4.5%, so keeping up just in line with inflation. But as we saw from their investor presentation, this is something they do want to restart very soon, including those share buybacks. And if we also take a look at the number of years, they haven't been increasing it for quite some time, but they have been paying a dividend for the last 22 years without a reduction. Now, looking at the metrics, kicking it off with the free cash flow, although as always, we will ignore earnings data. It is here if you want to see it. We do believe it is susceptible to manipulation by management through accounting. We want to see below 60%. Give us faith, they can continue to increase the dividend, something we haven't seen in quite some time, and we should expect them to have a nice increase, given in 2024 it was 24%. Over the next year, expected to be lower at 19%. And free cash flow, very important. We want to see consistency over the long term, not something we really know. In fact, every single year, it does look like it is very up, very down. There is no real pattern. But one thing to point out, over the next 12 months, it is expected to grow to $8.30. And if we were to look at their top line growth, again, quite a bit of inconsistency. Most recent year at 8%, but we do get some years in the mid-single digit. Some years are very healthy, but again, no pattern, no consistency, and no real obvious trend. In terms of the total sales from a top-line basis, they've pretty much doubled it from 2015's 2.7 billion to 2024's 5.7. And shares outstanding, something we always like to include in our analysis. We love it when companies return excess cash through share buybacks. They've diluted your position, although very minimally over the last 10. What is good to see though, in their investor presentation, as we just saw, they are expecting this to be one of their focuses of capital allocation moving forwards. ROIC, one of our favorite metrics, 10% or more. Give us faith, management are able to effectively allocate their capital. We don't get to see that consistent 10% year on year, but it does straddle around that with 8% in the most recent. And then we move on to the margins. Now remember, high quality companies, as we always say, will show us two things. One, increased revenue. Two, improvements to their margin. Now their revenue has been increasing, although inconsistently as noted, and their operating margin, whilst no real efficiencies, it is at least at a bare minimum above the minimum 12%, and we did see it earlier on a lot better than the sector comparative. And free cash flow margin, again, same thing to be said, no real consistency, but at least above that minimum 5%. And then we move on to the final metric here, the net debt to EBITDA. Remember the below, it correlates to both balance sheet strength, dividend safety. We want to see below 3. Numbers you see below, number of years it would take them to pay off all of their debt net of cash on hand, sitting at 2.71 in the most recent period, expected to come down although slightly, and not far off that maximum threshold. So what we would say, definitely something to keep an eye on. We do ideally want to see this start to decrease. yet from 2015 to at least 2023, we get the opposite of that, where it has been increasing. Again, something we will continue to look at on a quarter-by-quarter, year-on-year basis. Now, when we compare it to the S&P, we can see over the last year, it is up 3%, EFX down 8%, so they have in fact underperformed. When we expand to over the last 5, same conclusion, S&P up 94%, EFX up 78%, so they have although not massively different. And we get to see the same conclusion over the last 10 years, S&P has been up 158%. Remember, this is total return including dividends reinvested. EFX not far behind, up 151%, but as always, past performance not an indicator of the future. They perform a lot better, they could also perform a lot worse. And we can also do the same and compare them against others in the industry. We have Leidos Holdings, Walters, as well as many others that are very popular, similar size, similar sector as well. In terms of total return, EFX, the worst performing, down 7%, but you can see over the last year, it hasn't been the best industry to have been invested in. Very poor results, as we can see. When we expand to over the last 5 years, looking a lot better, up 80%, one of the best performing as well. And over the last 10, again, as we saw earlier, just marginally underperforming the S&P, up 151%, and actually the worst performing out of all of these others, with the vast majority performing some very good returns that shareholders would like to see. Now, we already covered their top line revenue. As we said, over the last 10 years, it has pretty much doubled, going from 2.7 billion to now sitting at 5.7. But what we want to understand is, what does the bottom line net income tell us? What is the story to be told? Is it consistent as in terms of the revenue growth we saw? But what we can notice, bottom line net income is actually very inconsistent. Whilst it has grown from 429 million in 2015 to now at 604, there have been many years where it has been a decrease and no real consistent trend, something that has become a bit of a theme in this analysis today. And we also want to highlight the balance sheet for a quick total cash versus total debt for a health check. Cash as well, very inconsistent, no pattern, no trend. It's gone from 93 billion to now sitting at 170 million in the latest quarter. But as always, we never look at any one of these figures in pure isolation, as they won't tell us anything in the balance sheet, which is why we compare it to their total debt numerically as well as directionally. And what we can actually see for this company today, it has been increasing over the last 10 years, going from 1.2 billion 2015 to now sitting at 5.2, far superior to the cash balance, and that is why we did get a fairly high net debt to EBITDA, something, as we said, we should keep an eye on. Now, in terms of the wider market, we can in fact see quite a mixed result. We did start the day pretty strong, green right across the board, although we are now starting to see companies turn slightly into the red. But perhaps in better news, the fear index is now sitting at 20. We are making our way slightly out of the extreme fear. Whilst investors are still very bearish, it is getting a lot better than we saw over the last 2 weeks, where this score was as low as 3 to 4. But the main thing to understand, not just with this company that we are analyzing today, but there are many companies in the S&P that are still trading at what we would say are fairly overvalued levels. We want to be looking at attractive companies like those like Alphabet, for example, that sits at below 16 on a forward valuation, as well as many others in the S&P, and that is something we like to bring to your attention whenever we do believe there is quality in the market. Now, just before we dive into the valuation, our in fact opinion of the company, we want to let you know just earlier today we have released our free weekly article where we cover 2 undervalued stocks that insiders have been buying a significant amount. Now remember, we do send one to your inbox every single Monday morning completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a copy of undervalued stocks for the month of April, lots of information for each one, the upside that Wall Street themselves see over the next year, as well as 97 stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, getting to our valuation today, we get to $262 derived from the DCF model. Now, we have the free cash flow year on year, including the most recent one where we saw 58% increase. Average growth is negative, skewed slightly as we have gone from negative to positive for a number of years, but moving forwards, we have gone for 15%. Now, you can see we have a low, medium and high. Numbers, as always, are very subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for this one or any others, but based on 15% with a discount rate, this in turn giving us the present value of future free cash flows, adding with the cash, subtracting total debt, getting to the equity value, dividing by shares outstanding, and we get to $262, which indicates 17% upside. Now, if you believe this is too low, for full transparency, we will show you at 20%, 386, 72% upside, and at 25%, we get to 557, 149, more than a double. Now, today we want to be extremely conservative at the 15% point, and we're not done there because we always take it through for an MOS, 10% execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that today, a buy at $235, and then we keep going till it's near the current trading price. And what we're saying right now for EFX, around a 15% MOS, with Wall Street themselves seeing this at 290 over the next year, which translates to 29% upside. Now, give us your thoughts. Do you believe it's a good opportunity? 15% MOS, 29% upside. And for those that want a larger margin of safety, which we probably do believe is fairly reasonable, at 20% a buy at 209, at 25 around 196, and at 30% around 183. Now, what we would say is at the 25%, that is pretty much at its 52-week low, and perhaps one where you could argue is definitely worth considering for over the longer term. But as we saw, valuation is pretty much in line with its averages and doesn't look to be extremely attractive at these levels. Again, give us your thoughts. Maybe you agree, maybe you disagree. Do you see this as a buy, hold, or sell? And don't forget to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.